In this video, we'll talk about the three different types of debt investments. And these are three different types from an accountant's perspective. So it could be the same bond that the company is buying, but for the accountant, there's three different categories. There's trading, available for sale, and held to maturity. And these three different categories are based on how long does the company intend to hold the investment. So a trading investment, the company intends to hold for a very short amount of time. A held to maturity investment, the company intends to hold the debt instrument until it matures, that is until the face value is paid off. And available for sale is somewhere in the middle. So not a short amount of time and not held to maturity, then it's called available for sale. So let's just talk a little bit about these investments, and we're going to look at a company's financial statements and talk about debt investments. So here we go. Here is Berkshire Hathaway's, the asset section of their balance sheet. And they have a bunch of different businesses that they're in. So they're in insurance and other. They're also in railroads, utilities, and energy. So they have a few different lines of business. And they list their assets separately for these lines of business. And the line item I want to focus on for this video is a line item, and let me get my laser pointer, the line item called investments in fixed maturity securities, right here. Investments in fixed maturity securities. And you can see that that account has a December 31st, 2019 book value of $18.685 billion, because this balance sheet is in millions. So that's the book value at December 31st, 2019. Okay, some more details about this account. So let me move myself up into the corner now. Details about this account, and this is just from the first footnote of Berkshire Hathaway's 10K, so right below their financial statements. They have a footnote on their accounting policies. And this is the accounting policies for their investments in fixed maturity securities. Now, again, fixed maturity means that it has a maturity date. So this investment has a definite end date, which is another word for a debt investment, because an equity investment doesn't have an end date. Your ownership goes on forever. And so that's an equity investment is indefinite, but a debt investment has a fixed maturity date. And there's only one sentence I want you to look at in this accounting policy. And that is that as of December 31st, 2019, Berkshire Hathaway says that substantially all of our investments in fixed maturity securities were classified as available for sale. So when we look at their financial statements and footnotes, we're going to have to keep in our minds that all of their fixed maturity securities have a available for sale designation. And let's see what we can see in their footnotes to the financial statements. So first of all, I've blown up the asset section of the balance sheet here. And you can see again this book value here, investments in fixed maturity securities, and it's $18,685. Then what you do is you go down to footnote number 3. And it's not always footnote number 3, it is for Berkshire Hathaway, but their footnote number 3 talks about these investments in fixed maturity securities. And they give you a table. Investments in fixed maturity securities as of December 31st, 2019 and 2018 are summarized by type below in millions. So at December 31st, 2019, Berkshire Hathaway owns investments in U.S. Treasury debt securities, U.S. government corporations and agencies, foreign governments, corporate bonds, and other. So those are the types of debt instruments that Berkshire Hathaway is invested in at December 31st, 2019. And now let's look at the columns of this table. This column is for the amortized cost, which is a little bit complicated way to just say this is the cost of those investments. So what did Berkshire Hathaway pay when they initially made these investments? And if you sum up all of these costs, it's $18.073 billion. That's the total cost. So they shelled out $18.073 billion in their own cash to invest in these securities. Since they originally invested, they've experienced changes in the fair value of those securities. So while they're holding them, this is just like when you're holding an investment, the value of it could go up and down, right? That's the point of investing. So they've had some unrealized gains. Unrealized means they haven't it hasn't paid off yet because they haven't sold their securities yet. So these gains are unrealized. And they've also had a smaller amount of unrealized losses. And so Berkshire Hathaway in general seems to be making pretty good investments in debt securities, in that they're having more gains. They have 626 million in unrealized gains and only 14 million in unrealized losses. And when you factor in these unrealized gains and losses, you get to what is the current day being December 31st, 2019, but what is the current day fair value of all those investments? And you can see that overall it's higher than what they cost. So since they bought those investments, the current day value of them is higher than what they bought them for. Their portfolio has increased in value, but they have yet to cash in on all of that portfolio. So now let's compare some of these numbers from the footnote to the balance sheet. You can see the book value on the balance sheet is 18,685,000, which is the same as the fair value, 18,685,000. And so this is exactly what happens when you designate your investments as available for sale securities. You hold your investment account, this is your investment account, and you hold it at fair value. So whatever the current market value of those securities is on December 31st, 2019, that is going to be the book value of those investments. So far we've seen that the book value is equal to the fair value, and that is because it's an available for sale security. Now this would also be the case if they had designated these investments as trading securities. Trading securities and available for sale securities, you hold book value at fair value. What is the difference between a trading security and an available for sale security? Well, you see these unrealized gains and losses. In a trading security, those gains and losses are recognized into net income. So if there was a gain, for example, and let's say all of this gain occurred in 1 year, you would debit your investment account by 626 million to increase it to fair value, and you would credit investment gain on the income statement, and that would increase net income in the year that the gain occurred. That is for a trading security, that these gains and losses flow to net income in the year that they occur. In Berkshire Hathaway's case, it's an available for sale investment. So these gains and losses have not yet been transferred into net income. They will be transferred into net income when Berkshire Hathaway sells the investments. So on January 1st, 2020, which is 1 day after this date here, suppose the fair value is the same. What could Berkshire Hathaway do since these are available for sale securities? They could sell all of these investments into the market. They would receive $18.6 billion in cash. They would remove these investments from their balance sheet. Then they would reclassify or transfer all of these unrealized gains and losses out of accumulated other comprehensive income, which is an equity account. They're all sitting in there. So there's a net credit balance sitting in accumulated other comprehensive income. If they sold these investments, all of the net gain, so 626 minus 14, would be transferred into net income at the time of the sale. So the entire holding period gains and losses get transferred into net income when the company sells these investments. So, okay, Berkshire Hathaway is, say, 600 million short. They're not having a very good quarter, and they want to boost their net income by $600 million. How could they do it? Well, they could sell all of their debt investments. Then all of these gains and small amount of losses gets transferred into net income, and net income goes up by more than $600 million. So that's something that they could do. And that's because these are all classified as available for sale. If they were classified as trading, they could not do it because all of these gains and losses are already in net income. Okay, so that's the difference between trading and available for sale. The third category, held to maturity. In that case, we, for the most part, ignore all of the unrealized gains and losses and fair value. We would ignore these numbers. And the book value of this asset, investment in fixed maturity securities, the book value would just be equal to its amortized cost. So that book value would just be sitting at the amortized cost value if they had identified these investments as held to maturity investments in debt securities. Okay, so those are the examples I wanted to go through. And I hope you enjoyed talking about those details of Berkshire Hathaway. And we'll talk about this in more detail later. See you next time. Bye-bye.